Now, I want to talk today about some of the specific things that U.S. banks are thinking about, and perhaps to give some insight to this lens through which U.S. banks are viewing their counterparties in Latin America, in Asia, in Europe, in the Middle East. Processing transactions linked to narcotics. We'll talk about corruption, and I'll talk very briefly about FATCA, which is another exceptional showing of American extraterritorialism. So the first thing that I will talk about is this impression of narcotics. And these are some of the information that a U.S. bank will have available to it, published by the U.S. government. And when the bank is sitting before the U.S. Senate will say, we have published this report, the International Narcotics Control Strategy Report. And we have identified certain jurisdictions which we believe move more narcotics money than others, and jurisdictions where we believe that the anti-money laundering controls are not as strong as others. And we've given this information to you. And here are some of the standards that they use in choosing the jurisdictions to whom they apply these labels. A jurisdiction of primary money laundering concern, called a major money laundering country, is defined by statute as one whose financial institutions engaged in currency transactions involving significant amounts of proceeds from international narcotics trafficking. So some of the factors that they look at in drawing what jurisdictions fit into that bucket: a lack of or inadequate know your customer requirements, well-established non-bank financial systems, especially where regulation, supervision, and monitoring are absent or considered to be lax, patterns of evasion of exchange controls by legitimate businesses, a lack of effective monitoring or cross-border currency movements. So these are some of the things that they'll look at in generating a list that has countries on it. From the U.S. institution then, the United States Department of State is saying that those factors apply in these particular countries: Argentina, Bolivia, Brazil, Paraguay, Uruguay, Venezuela. And what the U.S. government then is saying, if we have identified for you that these jurisdictions pose a high level of risk, what we expect to see within your policies and procedures is for you to document and then execute how you have dealt with transactions in business that touch those jurisdictions differently than you do other jurisdictions. The second category, a lesser category, jurisdictions of concern. While the actual money laundering problem in jurisdictions classified as being of concern is not as acute as those considered to be of primary concern, they too must undertake efforts to develop or enhance their anti-money laundering regimes. Some of the countries on that list: Chile, Ecuador, Guyana, Peru, Suriname. Now, sitting in this room, I would imagine that you would draw certain distinctions between various of the jurisdictions that I've shown you on this list. The point that I'm making to you is that in this particular report, which is of import to the firms themselves when they construct their compliance programs, there is not a distinction between these countries. They're on this list, and you are expected as a U.S. institution to react to that accordingly, and thus explaining why, again, U.S. banks are asking particular intrusive questions, evidencing a greater degree of transparency when they look at counterparties involving Chile, for example. Now, let me move to corruption. Worldwide, there has been an increased interest in corruption-related matters, again, evidencing an international trend. 15 years ago in Germany and in the United Kingdom, if one were to bribe a foreign official in the pursuit of obtaining business, one could write that expense off their taxes. It was, to that extent, normal and expected activity. Today, that is anything but the case. The United Kingdom and Germany have particularly robust enforcement measures against foreign corruption, and likewise the expectation of financial institution compliance programs in addressing corruption-related risk has increased significantly. What I have here is a particular example of a matter that put a lot of attention in the United States on the engagement of third parties. The accusation in the Walmart matter was that a whistleblower had claimed in 2005 that Walmart, for the purpose of building Walmart stores in Mexico, had bribed Mexican government officials to obtain zoning permits and other permissions to build these buildings. Walmart had begun an internal investigation in 2005, and it had quickly uncovered a massive amounts, I think 21 million US, in potential corrupt payments. That investigation, according to what has appeared in the press, in substance was brushed under the table, and Walmart did not react appropriately to what it had uncovered in its internal investigation. And it next saw the light of day in April 2012 when it appeared in the New York Times. This is a picture of the Pyramid of the Sun in Teotihuacan. The issue was that Walmart had allegedly paid bribes to government officials to build a Walmart store almost literally within the shadow of the pyramid. So one of the significant things to note about Walmart and these other corruption-related issues and the failing of an institution to take these into account and react accordingly with its corruption programs are that it costs a lot of money. Walmart, for example, in the period from April to December reported that it had directed more than 300 third-party legal and accounting experts who have dedicated in excess of 79,000 hours to this effort. As Adam mentioned, about a month ago, I was the director of the Global Anti-Corruption Program at JP Chase. And you may wonder why I left JP Chase for private practice, for the opportunity of helping institutions enhance their compliance structures to align with global norms and to help distinguish themselves to make it easier for them to do business. I would submit to you that part of the answer is in that line. There apparently is a market for this service that we hope to render. The Siemens matter, for example, resulted in some $800 million US in fines and penalties for Siemens. But the even more remarkable statistic is that Siemens, according to the press, paid upwards of $1 billion US in terms of its internal investigation and the resultant monitorship that it was forced to bear as a result of its settlement. Failure to react to corruption-related risk not only cuts the ability to do business, but it is an expensive proposition when one is confronted with the internal investigation. Now, on the other hand, we have the Morgan Stanley matter. Morgan Stanley was a Foreign Corrupt Practices Act, a U.S. action involving a managing director of Morgan Stanley, an employee in China, who bribed a Chinese official as part of a particular transaction. For the first time, the U.S. authorities did not bring an action against Morgan Stanley itself. It prosecuted the Morgan Stanley employee and sent him to jail, but it did not require Morgan Stanley to enter into any sort of settlement agreement with the government itself. And the reason why was that Morgan Stanley, according to the government, and it was for the first time that the government said this, had constructed an effective and efficient anti-corruption compliance program, and therefore the actions or misdeeds of its employee were an outlier. The construction of an effective compliance program served as a shield against the government coming against it and requiring Morgan Stanley itself to enter into some sort of agreement. Now, I will note that when I left JP Chase and we needed to find my replacement, we promptly went out and hired the former head of Morgan Stanley's anti-corruption program. So hopefully JP Morgan is in good stead there. With respect to corruption, I will note this. One particular area which we hope to help with, and we do think is a market distinguisher for entities that are doing business in Latin America and in Chile, is to construct effective and efficient compliance structures that speak directly to these increased expectations. If you are a counterparty in a merger and acquisition, or some other kind of deal with a U.S. bank, many of these deals go, in our parlance, south, or do not happen, because corruption-related issues come about at some part in the negotiation, and the U.S. counterparty decides that it cannot take on that level of risk, given the increased expectations that I mentioned before. So as a proactive insulator against that sort of reaction, the ability to assess risk early, to price reputation, business, and legal risk into the deal early and often, and to prepare for what's going to happen once a counterparty becomes, in essence, a U.S. regulated entity, is a market distinguisher. It enables that counterparty to separate themselves from the herd and become more valuable because they're able to speak this compliance language with their U.S. counterpart. And that's exactly what we hope to help clients do in Chile. In terms of risk assessment, specifically, in terms of these structures, they're not complicated in their articulation, and we try to make measures in terms of compliance effective and efficient in their application as well. But basically, it boils down to, what are you doing? What sort of activity are you engaged in? Are you building a Walmart in Mexico where you need to get permits from many government officials? And if so, how are you doing that? How are you monitoring the expenses of the employees who are facing up with Mexican officials? Where are you doing it? Again, jurisdictional risk. To what extent does it involve the government? These are part of the components of a risk assessment through which you would look to construct a compliance program to address these kinds of risks. Business hospitality, I mentioned. Political and charitable contributions. Are you making a charitable contribution to that of a government employee at his or her request in return for a particular favor? If so, that's a corruption-related risk, and a corruption compliance program would be expected to address that in the United States. The same thing with offers of employment. If someone says, it would be a wonderful idea if my daughter were to have a job with your exceptional firm for the summer, and in return I will grant you this business. In the eyes of a U.S. prosecutor, that's a bribe. And that activity, therefore, within the company would pose a corruption-related risk. I said I wanted to mention FATCA very quickly, and I will, because it imposes on to the U.S., again, foreign counterparties, an extra sort of level of compliance. It really is evidence of extraterritorial thinking on the part of the U.S. The point of FATCA is for the U.S. government to be able to identify United States citizens who hold accounts in other countries. And the purpose of that is to make sure that those United States account holders are paying U.S. tax. And in substance, what the statute requires is for a foreign financial institution to be able to report whether or not it has U.S. account holders. And so, in essence then, it imposes a know your customer type anti-money laundering compliance requirement on a foreign financial institution. The penalty is that if the institution has assets and controls in the United States could withhold 30% of the proceeds generated from the income on those investments. The sweetener of the deal, the point of the deal that's supposed to make it attractive to the foreign jurisdiction from the standpoint of the U.S., is that the U.S. says, we will tell you what account holders you have with our banks. So, for example, with respect to Brazil itself, the United States would say, we'll tell you what Brazilians have accounts in the United States, you tell us what accounts U.S. has accounts with Brazil, and it's a fair trade. It is a very, very significant additional KYC type requirement, and it really does remain to be seen how this will be applied in particular jurisdictions like China, for example, which will be very reluctant to share this kind of information, with very reluctant perhaps being an incredible understatement. So the point of my remarks, really, in an era of increased regulatory enforcement, to achieve success with a U.S. financial institution, it is in the interest of that counterparty to the U.S. institution to do everything it can to stand out from the crowd. And to the extent that it can put in place compliance controls that are effective and efficient and structured the way that the U.S. bank expects to see, creates a marketed incentive for the U.S. financial institution to choose that counterparty as opposed to another where it cannot see as accurately the risk that it faces with respect to that counterparty. So that concludes my remarks, and we are happy to take questions.